This is a lot of money. And we haven't even made it to the balance sheet yet. Here is that balance sheet. They're at $3.87 trillion in assets. Trillion with a TTT. They are doing banking things though and keeping that ratio of assets to liabilities at roughly 1.1. JP Morgan doing a good job despite its massive influx of cash. Putting almost all that additional asset base directly into loans. The bread and butter of this giant diversified bank. Cash flow statement. Credit loss provisions have been increasing since 2020. $9 billion is a lot of money. Let's not gloss over that fact. But $9 billion for this company, almost negligible. Less negligible is that the originations and purchases of loans held for sale, whatever that means, is less and less significant. This has been slowing down very noticeably over the last couple of years. Similarly, since 2021, JP Morgan has been decreasing something called trading assets by tens of billions of dollars as well. What all of this means when it comes together is JP Morgan has actually generated less cash in this last year than it has in the last several years. 12 billion versus over 100 billion was generated last year. Even though on the income statement there's a lot of interest revenue coming in, JP Morgan immediately pushing that into loans instead of trading assets. Now, at a high level, we can get a sense that JP Morgan likes the traditional type of banking business more than the investment banking business, which is where a lot of the trading happens. But that's still pretty high level. So in conclusion for the opening move, to understand what JP Morgan is doing, really just one of the things that it's doing, but certainly the biggest thing that it's doing strategically. We're going to look into their definition of trading assets and really try to understand together why they're decreasing the amount of those that they have, keeping in mind that the money coming out of that is being pushed back into generating new loans. What's a trading asset? Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. This annual report specifically is one of the hardest ones we will ever look at together. We have Control F for trading assets, and that has taken us to a selected data that immediately throws a wrench into what I was understanding. On the cash flow statement, tens of billions worth of trading assets were being sold. What it didn't show in the cash flow statement, even though tens of billions of trading assets were sold, that was because trading assets had ballooned alongside the general markets, appreciating very quickly in value. Let me show you this number, focusing on 508 billion. This is what is left after selling the roughly 70 billion, I think it was. And it's still over 100 billion more than what they had last year. Market price of those assets ballooned to almost 600 billion. P. Morgan sold off tens of billions of assets and is still left with an elevated level of trading assets. We can call this taking profits. We've now been poking around several tables for the last several minutes. I have noticed one note here that exemplifies the pattern that I've discovered by doing this. Here's a asset category called credit risk exposure to states and municipal governments. Ignore those words for a second. It's a type of marketable security. Some of that marketable security is called a held to maturity. Some of it is given a different tag. And one of the many tags that you can get for the same marketable security is a trading asset. By the time we make it to this section, a completely different section that's talking about the credit portfolio, so loans, they give us the definition that fair value, the relationship that all trading assets have in common is they're booked at fair value. If something is booked at fair value rather than one of the other options that you have as a bank, then you are putting yourself on the line for potentially being wrong at what your fair value is. As value investors, we should be hopefully familiar with the phrase intrinsic value. This is what we, when we've locked the doors, closed the windows, and scribbled on an Excel sheet for the 5 hours, come up as what we think the future cash flows are worth of whatever asset. Don't overcomplicate. Fine, I'll say it even simpler. If you think the price is X and the market price is exactly the same as what you think, then the trading asset would just be the purchase price. That's not when this is interesting. For many securities, JP Morgan tells its bankers to value them, and the price that they think the value is, aka X, is different than the actual price. They buy that asset and assume that they're correct. In a typical long situation, a JP Morgan banker goes to their managing director, says, I think asset XYZ is worth $20 a share. It's trading at $5 a share. JP Morgan will buy shares at $5 in the open market and immediately book that as a trading asset that has a value of $20 a share. So a share asset that they just bought for $5 is booked at a $15 loss. Why do they do this? Because they're a bank that's regulated and because it's good risk management. They have recorded a negative asset value because they're tracking trading assets. They don't intend to do anything with this asset other than trade it. And so for them, it might as well be a liability. It might as well be a negative asset. We can do nothing with it until the value starts to appear again. In the case of JP Morgan, they've been doing this for so long, for so many years, that overall their portfolio of trading assets is in the hundreds of billions of dollars, meaning that they have purchased large quantities of different marketable securities when they thought that they were mispriced. And the correction in price since the purchase has ballooned to well over $500 billion in value that JP Morgan is just sitting on. They don't need that money, so they're not going to sell these assets until they need that money. This makes it different than other reasons why a bank might purchase assets. Held to maturity investments, usually debt, not be recorded at fair value because that is being used as a source of income. You want to track that in your balance sheet as what it is, not just something that you're holding until it reaches a new price, which would be a trading asset. But in the other case, you could hold it as a source of income that's held to maturity. There's probably about 5 or 6 major categories of different accounting styles when you purchase a stock. Trading assets we've uncovered is just one of them. And specifically in the last year, we've now returned to the cash flow statement. JP Morgan has seen opportunities to finally sell some of those trading assets that had appreciated in value. It has sold well over 100 billion in those assets in the last 2 years because it found other ways to use the money. We saw in the income statement way back at the beginning that they were originating a lot of loans. We saw in the balance sheet way back at the beginning that they're originating a lot of new loans. But the story here that we've figured out is assets purchased by JP Morgan years ago, intended to be traded, have had their price get a lot closer to the underlying value or even exceed the underlying value. JP Morgan saw opportunities to generate a lot of new loans last year, so they sold some of those trading assets in order to fund the origination of new loans. That's how we condense one of the beefiest annual reports we will ever see into a simple story for the 2023 season. We learned together last year just how gigantic JP Morgan is. Certainly the large banks can seemingly do no wrong in the 2023 season. And good for them, I guess. I don't know. To be honest, guys, I have a high standard for what it takes to go through an annual report. The reality is that the bank is far too big to be understood probably ever. If you're investing in this thinking, oh, I'm going to understand everything that the bank does, then you shouldn't be looking at a company with 3 trillion plus in assets. You might be better served if that's really what you want, is to understand everything that goes on in a business. You should probably find a company with maybe a 0.001% level of that many assets. 0.001% of this would still be larger than the majority of companies in the Russell 2000. I now want to guess what the Sage Seeds AI ranking is going to be. I'm having trouble guessing what the Sage Seeds AI ranking is going to be. It's making a lot of money. This has to be a good ranking. I don't know, top 20%. I'm really not sure. Sage Seeds AI is now going to give us a valuation ranking. Sage Seeds AI is trained to identify value investment opportunities. Tell your friends, try to guess what the ranking is going to be before you see it. And whichever one of you gets closer to the actual ranking is clearly destined to become a future financial sage. JP Morgan Chase ranked 51 out of 487 in value for the 2023 season. This is well into the top 20%. It is in the 11th percentile, meaning that it's just barely outside of the top 10% of very good ranking in the 2023 season. Materializing tens of billions of dollars out of thin air is a good way to raise your ranking. Certainly, the large banks are going through a period of very high profit margin. And while that sort of stuff used to be literally hated, let's not forget that for almost 15 years since the financial crisis, banks have basically been surviving off of return on assets in the 1 to 2% range. They were basically making no money for a long time. And now, all of a sudden, banks make money? Who knows how long it will last? In future seasons, JP Morgan will almost certainly remain a fascinating company to study. We'll watch the roller coaster together in future seasons.